$300 trillion. That's how much is sitting in high quality assets around the world right now. And get this, only about 10% of it is actually being used. Meanwhile, the OCC just handed Crypto.com a federal bank charter. Canton Network is settling tokenized UK government bonds in real time. And the SEC is forcing $4 trillion a day into new clearing infrastructure. Yeah, I'm making a prediction today, and I think it's going to age really well. Okay, so here's what just happened. The OCC conditionally approved Forest Dax National Trust Bank, that's Crypto.com's legal entity, to operate as a federally chartered trust bank. A national trust bank charter is the gold standard for crypto custody. It means Crypto.com can now offer institutional-grade digital asset custody, multi-chain staking, and trade settlement, all under federal oversight, not state by state. They're joining a pretty exclusive club. Ripple got theirs in December, Circle, Paxos, BitGo went full charter, Fidelity Digital Assets. Even Bridge, which Stripe acquired, got approved the day before Crypto.com. But here's what nobody's talking about. 5 major banking groups, the ABA, the ICBA, formally asked the OCC to block these charters. They called it regulatory arbitrage. Their argument? Crypto firms get federal legitimacy without FDIC insurance, without Community Reinvestment Act obligations. And honestly, they have a point. But Comptroller Jonathan Gould said, quote, "New entrants into the federal banking sector are good for consumers, the banking industry, and the economy." He said there is, quote, "simply no justification for considering digital assets differently." So the banks are upset, and the regulators basically said, deal with it. Now this is conditional. Crypto.com still has to prove they've got compliance infrastructure and AML programs. And look at Anchorage Digital, first federally chartered crypto bank in 2021, got hit with an OCC consent order. Took tens of millions of dollars to fix. So the bar is real. Here's a name most crypto people aren't paying attention to. Canton Network. And that might be the biggest mistake in this space right now. Canton isn't some layer 1 hoping for institutional adoption someday. It already has it. Goldman Sachs, DTCC, Euroclear, London Stock Exchange, Citadel Securities, over 600 institutions, $6 trillion in on-chain assets. And now, Xebec Network just entered the Canton ecosystem through Lattice, the first neobank built natively on Canton. Xebec is a real-time streaming payments protocol. They let you pay employees by the second. They've got partnerships with NatPay, which processes $170 billion annually, and they joined the Nacha Payments Innovation Alliance alongside JP Morgan and Circle. So picture this. A Treasury manager holds tokenized UK government bonds on Canton, earns repo yield around the clock, and an employee spends that yield in real time via a MasterCard debit card through Lattice, all within one privacy-preserving regulated ecosystem. Now, I want to be honest about a risk. Xebec's founder was connected to the Movement Labs Move token scandal. 38 million in tokens dumped on listing day. He denied involvement, but that's not great optics when your value proposition is institutional trust. Still, Canton's privacy model is architecturally different from anything else out there. Only the parties in a transaction can see it. The validators can't. Goldman can settle tokenized treasuries on the same chain as BNP Paribas, and neither sees the other's activity. That's not a feature. That's the whole point. Before I get to the next story, quick question for you. Do you think traditional banks are going to lose their monopoly on custody and settlement within the next 2 years? Or is this all just regulatory theater? Drop your take in the comments before you hear mine. Okay, I know. Cross-border collateral mobility. Sounds thrilling, right? But stick with me here, because the numbers are actually insane. Kelly Matheson, the Chief Business Development Officer at Digital Asset, said there are about $300 trillion in high-quality liquid assets globally, but only about 10 to 11%, roughly 28 trillion, is actually being used as collateral at any given time. The rest? Just sitting there, locked up because the plumbing to move it across borders is too slow, too fragmented, and too expensive. And today, Canton's industry working group just completed their fourth set of transactions. This time, first ever cross-border intraday repo using tokenized UK government gilts. First ever cross-currency repo on a blockchain. LSEG, Euroclear, DTCC, Citadel Securities, TradeWeb, Societe Generale, Arcax. 12 institutions running live production transactions. Now let me explain why this matters. Right now, if you want to move collateral across borders, you need to plan days in advance. You're dealing with batch processing windows, different time zones, different central securities depositories. London closes, but your New York desk still needs those gilts. And because settlement takes T+1 or T+2, firms over-collateralize by 10 to 20% as a buffer. That's hundreds of billions locked up as insurance against slow pipes. Canton eliminates that. Atomic delivery versus payment. Both sides settle simultaneously or not at all, 24/7, across jurisdictions. And here's the kicker. The ECB just announced in January that tokenized government bonds will be accepted as eligible collateral for Eurosystem credit operations starting March 30th, 2026. The European Central Bank accepting tokenized bonds as collateral. That's not a pilot, that's policy. Graham Rodford from Arcax said it perfectly. Leveraging their broker and custody permissions to buy traditional assets like gilts, then using their tokenization engine to create regulated digital representations for use cases exactly like this. That's the bridge between old finance and new infrastructure. Here's the connection nobody's making. The SEC has a central clearing mandate for U.S. Treasuries. Phase 1, cash market transactions, deadline is December 31st, 2026. Phase 2, repo transactions, June 30th, 2027. And this is going to force over $4 trillion in daily Treasury trading through central clearing infrastructure. Now, why did the SEC push this? Because of what happened in March 2020. COVID hit, everyone panic sold treasuries. Dealers couldn't absorb the selling pressure because 70 to 80% of the treasury market was uncleared bilateral trades. The Fed had to step in and buy over $1 trillion of treasuries in weeks just to keep the market functioning. Then the UK gilt crisis in 2022 reinforced the lesson. Leveraged, opaque positions in sovereign bond markets can cascade into systemic crises. So now the SEC is saying, enough, clear it all. But here's where it gets really interesting for our conversation. DTCC announced in December 2025 a partnership with Digital Asset to tokenize DTC custodied treasury securities on the Canton network. Production planned for first half of 2026. And SEC Commissioner Mark Ueda said in February, and I quote, "Both treasury clearing and tokenization serve as reminders that modernization is not an abstract goal. It is a practical necessity." Now the hedge funds are not happy. SIFMA identified a double margining problem where repo lenders have to post 102% collateral and separate CCP margin. The estimated incremental margin requirement? Over $40 billion. The basis trade, currently about $1 trillion in notional, could see economics severely disrupted without cross-margining arrangements. But here's the thing. If you connect all four stories from today, crypto firms are getting bank charters. Canton is proving that tokenized government bonds can settle atomically across borders. The ECB is accepting tokenized bonds as collateral, and the SEC is forcing the world's largest bond market into new infrastructure. These aren't separate stories. This is one story. The traditional financial system is being replumbed, and the new pipes run on blockchain. So look, I told you at the top I was making a prediction. Here it is. By the end of 2027, federal bank charters, atomic cross-border settlement, and tokenized Treasury clearing will not be separate conversations anymore. They'll be the same system. The institutions know it, the regulators know it, and now you know it too. I'm genuinely curious what you think. Is this the real deal, or am I reading too much into it? Let me know in the comments. And if this is the kind of analysis you want more of, you know what to do. Subscribe for institutional grade crypto analysis. Drop your prediction for 2027 in the comments. Will tokenized treasuries replace traditional settlement? Like this video if you made it this far.